16 of 21 series are aligned with acceleration mild this morning. That is a moderate level of systematic agreement across the framework's 21 series. The current macro regime is acceleration mild, with a confirmation score of 16 out of 21. In this acceleration mild macro regime, the math is observing growth momentum in an acceleration band at roughly plus 0.02, and inflation momentum also accelerating near plus 0.00. That combination means the framework is seeing economic activity and price pressures both strengthening on a rate of change basis rather than cooling. The coherence score is in a moderate range, and the confirmation score of 16 out of 21 series reflects a solid, but not extreme, level of alignment across the macro, credit, rates, and volatility complex. Historically, by the framework's record, regimes with this level of confirmation score have persisted around 47% of the time over rolling 3-month windows when reached from similar configurations, with stagflation-type regimes the most common next state in the sample. Compared to recent weeks, confirmation has stepped up into this 16 series band, and inflation momentum has firmed. Historically, environments like this have felt like heavier cross-asset rotation. Commodities and energy often led, bonds often struggled as rates pressed higher, and inflation-sensitive real assets drew more of the market's attention, a record of past behavior, not a roadmap. Let's walk through 4 signals the framework is watching inside this environment. First, Treasury yields. The 10-year Treasury yield is sitting near 4.69%, with the 2-year around 4.33% and the curve modestly positive, and the Bond Volatility Index reading in a normal percentile band. The engine currently marks the 10-year yield signal as ready, meaning yields are elevated and have moved higher on a defined mathematical slope over recent sessions. In our framework's reading of comparable periods, this roughly coincided with pressure on traditional long bond portfolios and more selective risk-taking in duration-sensitive assets within 1 to 3 months, an observation under our methodology, not a forecast. The question for investors has historically been whether that rate backdrop changes how much rate risk or leverage they are comfortable carrying. What would challenge this read would be a sustained retreat in long yields back below recent range highs and a cooling in bond volatility. Second, the labor signal, anchored by non-farm payrolls and unemployment. The Fed's latest communication described employment gains as broadly in line with labor force growth and unemployment as stable, which the framework interprets as a neutral to mildly firm labor backdrop. Here, the labor composite is closer to a yellow band, neither strongly accelerating nor sharply weakening. In our framework's reading of comparable periods, this roughly coincided with earnings remaining supported while markets watched closely for any inflection in hiring or layoffs over a multi-month horizon, an observation under our methodology, not a forecast. The question it raises is whether a steady labor market confirms current equity and credit pricing or starts to challenge it if wage and cost pressures persist. A clear challenge to this interpretation would be either a sharp reacceleration in hiring or a sudden rise in unemployment claims. Third, credit conditions, captured through measures like high-yield credit spreads and lending standards. The engine is marking credit as red in terms of momentum, with high-yield spreads having widened recently and the Fed signaling tighter overall financial conditions. In our framework's reading of comparable periods, this roughly coincided with stress building in more leveraged, credit-sensitive sectors within a few months, an observation under our methodology, not a forecast. The question for market participants is whether this kind of credit backdrop changes their tolerance for lower quality exposure or complex structures. What would challenge the read would be a clear, sustained tightening of spreads and evidence of easier credit availability. Fourth, the equity sector rotation signal. Technology futures are down around 1%, energy futures are off near 2%, while financials, healthcare, industrials, materials, gold-linked exposures, and long-duration bonds show relative stability or gains. The engine tags this as a mixed rotation with a green momentum red in defensive and real asset groups and red in high-growth, rate-sensitive technology. In our framework's reading of comparable periods, this roughly coincided with investors shifting attention toward balance sheet strength, cash flow visibility, and inflation hedges over subsequent weeks, an observation under our methodology, not a forecast. The practical question it raises is whether current sector positioning matches the regime the engine is observing. A challenge to this pattern would be a decisive recovery in technology and cyclicals without corresponding changes in the macro inputs. On the conditional map, two triggers stand out. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, in our framework's reading, inflation composites showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In the current acceleration, or mild regime, such a move would strengthen the mathematical case that rate of change in inflation remains firm alongside growth. If the Fear and Greed Index drops below 15 and holds there for 5 consecutive sessions, in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 comparable conditions. A historical characterization, not a forecast. In regime terms, that would mark the environment as one where risk sentiment historically undercut coherence across the 21 series. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does two things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework, price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. That posture is potential, educational, mapping data so members can evaluate implications for themselves. The morning brief is the public surface. The live observation desk shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the engine's outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com. Free to try, no credit card for the first 500 founding members.